If you're holding stablecoins, here's the scary part. You can lose money without Bitcoin crashing, without a depeg, simply because redemptions freeze or platform liquidity disappears. You did what every smart crypto investor does. You took profits. You moved into stablecoins, the digital dollars that are supposed to be the safe zone when everything else is bleeding. But here's the uncomfortable truth. Stablecoins are not cash. And when I say investing, I mean parking value, holding stablecoins for safety or yield, not buying them for upside. They're financial products built on promises that can break under stress. And the stablecoin market is now so large, with a market cap around $300 billion here in early 2026, that if something snaps, it doesn't stay contained. It spreads fast. And most people won't see the landmine until it's too late. Today I'm going to show you the 5 hidden risks most people don't price in. Depegs, DeFi yield traps, reserve and custody risk, regulatory shocks, and the headline risk that can freeze an issuer overnight. And at the end, I'll give you a simple checklist to protect yourself. Because the scariest stablecoin losses don't happen when Bitcoin crashes. They happen when everyone thinks they're being safe. The single most important job of a stablecoin is to hold its peg. One coin, $1. Simple. But when that promise breaks, it's called a depegging event, and it's the crypto equivalent of the ground opening up right under your feet. Here's why this is so critical. Your entire strategy of being safe depends on this one simple promise holding true. Think your dollar is worth $1? Let's talk about Terra Luna. In May of 2022, the crypto world watched a financial car crash in slow motion. The Terra ecosystem, built around its algorithmic stablecoin, UST, completely imploded. Unlike a coin like USDC, UST wasn't backed by actual dollars. Instead, it used a clever but fatally flawed algorithmic dance with its sister token, Luna, to hold its peg. The idea was that traders could always swap between the two to keep the price stable. But that digital balancing act collapsed. When a few big players started selling off their UST, it kicked off a death spiral. As UST's price fell, the algorithm went into overdrive, minting trillions of new Luna tokens to try and prop it up, which only made Luna's own price crash to zero. In 1 week, both tokens were wiped out. UST plunged to 10 cents on the dollar, and an estimated $45 billion in value was just gone. It incinerated the life savings of people who thought they were holding a stable asset and sent shockwaves that took down other major crypto companies. Rule number 1, if the peg depends on an algorithm and confidence, it's not a stablecoin. It's a time bomb with a timer you can't see. Now, it's easy to write that off as a crazy algorithmic experiment. But what if even the safest, fully backed stablecoins aren't immune? Fast forward to March 2023. This time, the coin was USDC, issued by Circle, widely seen as one of the most reliable digital dollars out there. The problem wasn't in crypto, it was in the old school banking world. Silicon Valley Bank, a huge partner for tech and crypto, was collapsing. Then came the bombshell. Circle announced that $3.3 billion of its cash reserves, the money backing USDC, was stuck inside the failing bank. The market didn't wait. Panic was immediate. The promise of one-to-one backing was broken, and investors scrambled for the exits. Within hours, USDC, the supposed gold standard, depegged, dropping as low as 87 cents. For a terrifying moment, $1 was no longer $1. Rule number 2, if the peg depends on bank custody, your digital dollar is only as safe as the weakest bank link. And there's a bigger version of that same risk, reserve opacity. A stablecoin can say it's backed, but the details matter. Cash, T-bills, repos, money market funds, or riskier paper. Cash and T-bills are one thing. Long-dated paper and other assets are another. Because in a panic, backed isn't the question. Backed with what? And how quickly can it be redeemed? That's the question. Because in a run, liquidity is the product. Circle did manage to get the funds back and restore the peg, but the event shattered the illusion of absolute safety. It was a brutal lesson. Your digital dollar is only as safe as the bank holding the real dollars. So far, we have two ways you can lose: an algorithmic death spiral and a crisis at the bank that's supposed to be holding the cash. Even Tether, USDT, the biggest stablecoin, has seen its peg waver during moments of extreme market stress. Even if these dips are temporary, they expose a crack in the system, the part that matters for your wallet. In a crisis, the redemption process can seize up, leaving you holding an asset that's suddenly worth less than you thought. And next, we'll cover the risk that hits people who did everything right. The stablecoin never depegs, and they still can't get their money out. The appeal of stablecoins isn't just dodging volatility. It's also about that sweet, sweet yield. DeFi platforms like Aave and Compound offer tempting interest rates, way better than your bank savings account. It sounds perfect, right? Lend out your stable digital dollars and just collect a steady return. But what if the platform you're lending on is the real source of risk? Translation: you could lose money even if your stablecoin never, ever depegs. This is the second hidden risk, hiding in the complex machinery of DeFi lending. When you deposit your USDC into a lending pool on Aave, others can borrow from it by putting up their own crypto as collateral. The interest they pay becomes your yield. It's a beautiful system, until it's not. First, there's the risk of a mass liquidity crisis. Picture this. Market-wide panic sets in. Lenders, people just like you, all rush to withdraw their funds at once. The problem is, a huge chunk of those stablecoins have been lent out. There simply isn't enough cash on hand. Suddenly, your funds are stuck. The withdraw button is useless. That's a depeg in your life, even if the chart still says $1. The price says $1. Your access says denied. In that moment, you learn the difference between owning a stablecoin and having a claim on a pool that may not have liquidity. Your stablecoins are still yours, and they're still worth $1, but they're trapped by the protocol's liquidity. The second, and even scarier risk, is collateral failure. Loans on these platforms are backed by collateral, usually other crypto like Ethereum. If the value of that collateral drops too much, the platform is supposed to automatically sell it, liquidate it, to make sure you, the lender, are kept whole. But what happens when the market crashes so fast that the liquidation can't keep up? What if the collateral's value falls below the loan's value before it can be sold? This creates a deficit in the lending pool. That hole is supposed to be patched by the platform's insurance fund, or safety module. And here's the trap. On many platforms, including Aave, that insurance fund is made up of the platform's own token. In this case, the Aave token. Think about that. In a massive market crash, the value of tokens like Aave would be tanking at the exact same moment the insurance fund is needed most. It's like buying insurance that only pays out if the house doesn't burn down. That's called wrong way risk, and it's exactly what shows up in crashes. The promise of high yield on a stable asset is powerful, but it hides the complicated plumbing. You aren't just exposed to your stablecoin's risk, you're taking on platform risk and the risk that the insurance itself might fail. And if you think, fine, I'll just hold stablecoins in my wallet, good, but you're not done. Because the next risk doesn't care what coin you hold or what platform you use. Regulation can change the rules overnight. If the tech and market risks weren't enough, there's a bigger storm cloud over the entire stablecoin industry. The mess of regulation. For years, crypto has existed in a legal gray zone, and stablecoins are ground zero in the regulatory tug of war. Here's the punchline. In a crisis, someone gets protected, and someone gets trapped. With no clear rules, stablecoin holders are guessing where they rank. As of early 2026, there is still no single comprehensive federal law for stablecoins in the United States. It's not for a lack of trying. Lawmakers have been kicking around bills for years, but they always get bogged down by political fights. What we're left with is a confusing patchwork of state-level rules and federal agencies all trying to claim jurisdiction. In plain English, what does this chaos mean for your money? It creates a risk of regulatory arbitrage. Issuers gravitating to lighter rules. An issuer can set up shop somewhere with flimsy requirements for their reserves and auditing. This directly affects what's backing your stablecoin. Is it ultra-safe US Treasuries or a sketchy mix of other assets? Without strong, standard rules, it's almost impossible to know for sure. The risk for you is holding a coin that's considered safe in one part of the world, but a liability in another. Meanwhile, other parts of the world are getting their act together. The European Union has its landmark Markets in Crypto Assets, MiCA, regulation, which sets clear rules for stablecoin issuers on everything from reserves to transparency. Japan and Singapore have also rolled out their own comprehensive frameworks. This global inconsistency is a huge risk. A stablecoin banned in a well-regulated country can just operate somewhere else, creating dangers that cross borders. You could be holding a stablecoin from a company operating under a questionable regime thousands of miles away, with zero recourse if it all goes wrong. The process in the US is still painfully slow. Until a real federal bill is passed, the stablecoin market will remain the Wild West, which leads to the most unpredictable risk of all, the day a stablecoin becomes a national security headline, and the response is instant. There's one final darker side to stablecoins that doesn't get much airtime, but it's a huge focus for national security agencies. Because they are fast, global, and relatively anonymous, stablecoins have become a go-to tool for anyone trying to operate in the financial shadows. The features that make stablecoins great for you, fast, cheap, borderless payments, also make them perfect for rogue states and criminal groups. Some widely used stablecoins can let them move huge sums of money around the world instantly without ever touching a traditional bank. Multiple reports and analysts have warned that stablecoins can be used to route payments around restrictions, especially through offshore brokers and exchanges. This can be for a range of activities, including restricted goods. Exact details vary by report, but the risk is the same. It pulls stablecoin issuers into geopolitical crossfire. This adds a whole new layer of risk. It's not just about financial stability, it's about national security. And here's why you should care. If an issuer gets hit with enforcement or sanctions pressure, legitimate holders can become collateral damage. An issuer caught facilitating sanctions evasion could have its assets frozen or be cut off from the banking system. Imagine a top stablecoin issuer gets hit with sanctions by the US Treasury. Its bank accounts could be frozen, and its ability to redeem your tokens for real dollars could be shut down overnight. Redemptions could be disrupted, and that's when pegs break, leaving you as collateral damage. The heart of the problem is the lack of consistent rules forcing issuers to monitor their blockchains for illicit finance. While some issuers cooperate with law enforcement, many others in lax jurisdictions take a more hands-off approach. That turns their platforms into a haven for bad actors. So now the question becomes, how do you use stablecoins without becoming the person holding the bag when any one of these risks hits? After wading through this minefield of risk, it's easy to feel like there's nowhere safe. But fear isn't a strategy. The goal is to become a smarter investor who understands and manages these risks. Here's the stablecoin safety checklist. Screenshot this. This is the difference between parking and praying. First, don't single point fail. Split across 2 to 3 top stablecoins. The old rule about not putting all your eggs in one basket has never been more true. Spread your holdings across several of the top tier, transparently backed stablecoins. That way, if one has a crisis like USDC did, your entire stack isn't at risk. Second, know the backing. Prioritize transparent, frequent reserve reporting. Not all stablecoins are the same. You need to know what's securing your digital dollar. The safest bets are fiat collateralized coins. But even then, you have to do your homework. Go to the issuer's website. Look for their reserve reports. Is it 100% cash and short-term US Treasury bills? Or is it a mix of riskier assets? If you can't explain what backs it in one sentence, it's not stable. It's opaque. Third, separate custody from yield. Keep core funds off DeFi. Earning yield is tempting, but it is never, ever risk-free. Consider lending out only a portion of your stablecoins and keeping the rest in a secure wallet you control. If it's rent money, it shouldn't be in DeFi. Fourth, treat yield like risk. If you're earning more, you're insuring someone else's leverage. Before you deposit anything, investigate the platform. Has it been audited? How big is its insurance fund? And what is that fund made of? Don't just chase the craziest yields. They almost always come with the craziest risks. Finally, have an exit plan. Know your fastest path back to cash. Always know how you're going to get out in a crisis. This means using exchanges and platforms that have plenty of liquidity and a track record of not crashing during high-stress moments. When panic hits, the ability to quickly swap your stablecoin back to cash is all that matters. By following these principles, you can navigate the tricky waters of the stablecoin market. Here's the truth. Stablecoins are one of the most important innovations in crypto. They're a bridge between the old financial world and the new. But they are not cash. They are complex financial products, and every single one comes with its own hidden set of risks. We've seen how algorithmic dreams can turn into a $45 billion nightmare with Terra/Luna. We've seen how a traditional bank failure can break the peg of a safe coin like USDC. We know the tempting yields in DeFi come with the hidden dangers of liquidity traps. And we know the shadows of regulatory chaos and illicit finance hang over the entire industry. The promise of a stable digital dollar is powerful, but it's a promise you have to constantly check for yourself. No stablecoin is 100% risk-free. The key is to understand the risks, respect them, and build a strategy that protects you. The future will probably bring more regulation, which should hopefully clean things up. But until then, doing your own homework is the only true safeguard. If this breakdown helped you see the stablecoin market a little more clearly, hit that like button and subscribe for more content that cuts through the hype. Now I want to hear from you. If stablecoins aren't cash, what should they be regulated like? Banks, money market funds, or something new? Drop your thoughts in the comments below. Stay safe and stay informed.